All right. Good morning, everybody, and welcome to the Friday morning pre-market rundown here. My name is Kevin Hoffman. I'll be your host for the next 30 minutes here. I am a co-founder of Triggercharts, as well as Andrew Horowitz. Today, we'll be looking at quite a few different things. We had a really great unemployment report come out this morning. But before we get started, if you guys could, in the chat, just let me know if you can hear me okay, or if I need to change the levels or move the volume up or anything like that. But before we get started, investing involves substantial risk. Past performance is not a guarantee of future results, and a loss of original capital may occur. Please consider this for educational use only. And as always, use your best judgment when investing. Now, let's get right to it. Today, we're going to talk about the unemployment report. We're going to talk about the potential issue that's underlying with the seasonal adjustment impact of that unemployment report that we heard or that we saw today. We're going to look at some of the earnings, how they've been going. Looks like inflation measures are starting to ramp up, and we'll take a look at the stimulus talk updates and whether or not we may see an executive order here from President Trump, or if Congress may get their act together and put something together for those people who are unemployed or needing assistance. So before we get into some of that discussion, I'd like to take a look at some of the levels on the S&P and the NASDAQ, as well as some of the other major markets. So let's pull that up. S&P had a pretty has been just constantly moving higher, having a breakout here on both. Let's see what we're on here, the daily, and what's he got here, a 30-minute. But if you see on the daily here, we've been in a buy zone well above this altimeter range here, the most current one. We did see some markings here in the past of a little bit of an overheated level, but typically on the buy side, the overheated level should be taken with caution on the aileron, just because the affinity for the market to continue higher, especially in a low interest rate environment that we've seen recently, as well as high stimulus measures from the U.S. government. So just be cautious taking some of these overheated levels on the aileron to try and short into, but certainly has been the trend higher here. We are moving back toward some of these all-time highs that we've seen here. All-time high looks like on the SPY, we're around 339.08. We're at 334.33 right now. Seeing a little bit of downward pressure on the S&P 500 this morning, 35 basis points, not a huge move lower, but considering the unemployment report that we saw this morning, kind of an indication that, all right, maybe the unemployment report wasn't quite as good as what they thought it was going to be, or maybe we're in this reverse cycle where good news is bad news, in the form of the fact that we may not need stimulus anymore. But we'll see how that goes from there. NASDAQ just on a tear. I mean, you cannot get much more of a long-term uptrend than this since the pandemic lows here in March, and just a pretty easy trend line that you see moving higher here on the NASDAQ. So looking good on the NASDAQ. Not a whole lot of levels that we can take a look at, considering that we're in no man's land when it comes to this particular index. However, if you look back to this particular altimeter level, this will be a good level of support, at least in the short term. If we do start to trace back into these levels, and you could see there may be some consolidation here, I would guess to say that there's a pretty big, there's a huge line in the sand here on the radar, which is at around $260 on the NASDAQ 100. We're currently trading around 274, 275 right now. So keep an eye on those particular levels if we are to trace back, but the continued slog higher is probably the continued trend until something may change, whether it's not an agreement on the stimulus talks or increased COVID cases, or a second wave moving into Europe, or maybe some geopolitical tensions that we may be seeing with China, since we did see Trump sign an executive order this morning with regards to limiting WeChat as well as TikTok sales in the U.S. So a couple things to keep an eye on there. The Russell 2000 has been the weakest of the bunch, currently kind of in a consolidation mode here. It did break out from the most recent altimeter here, but we have this altimeter previously when we look left that's showing that we kind of have some top end around this 153 half level or so. So look for that to kind of test that high level there and see if it can break higher. But small caps have had a really difficult time trying to recapture back to their all-time highs, like the NASDAQ has. Some of these small companies have certainly been struggling a lot more than larger companies that have better access to capital markets and have plenty of cash reserves. So keep an eye on that. Emerging markets. Now, this is an interesting play here in the emerging markets. We'll talk about this a little bit more as we go through our outline, but emerging markets could become an interesting play, at least in the short to midterm, especially with the U.S. dollar continuing its major decline. Let's just take a quick look at that. The U.S. dollar, that's the $ DXY. We can see that, since the pandemic, you saw this huge dollar spike as people fled over to kind of the safety trade. The U.S. dollar has always been the safe haven for anybody in the international space to move into in order to make sure that their money's in safekeeping. But after this complete spike, we've kind of seen this slow trend lower on the U.S. dollar, moving down from like this 102 level down to 93. So, it's a large move when it comes to currency trades when you're seeing a currency move down 10% plus or so. But a lot of this has to do with the fact that our COVID cases are extremely high by comparison to Europe or Japan or other countries around the world. And then also on top of that, the devaluation of our dollar based on the fact that we're stimulating so much and interest rates are so low. Now, when this is important for investing, especially when it comes to emerging markets and international stocks, because as the dollar declines, you also get that boost in currency value of the dollar decline. So if the dollar's down 10% against an emerging market currency, you're going to get a 10% boost on any emerging market positions that you may have that are held in that foreign currency. So as the dollar declines, you'll see that. And one of the major issues that emerging markets and international stocks have had for the past several years was the continued dollar strength. And I'm not sure if we can look back. Let's see if we can look back further. But if we change this to a weekly, I think we'll see continued dollar strength. Over the past several years, you see, in 2014, this large rise, and then just kind of continued, held constant strength in the U.S. dollar, which has kind of held some of the international and emerging market indices down a little bit due to that currency deterioration. So something to keep an eye on. A lot of calls for continued U.S. dollar declines just due to, like we talked about, the COVID and the stimulus measures, or I should say unprecedented stimulus measures that we're seeing coming from our government. But anyway, back to emerging markets. looking very similar to kind of an S&P or NASDAQ type move, trending higher and higher and higher. I think EM space is probably going to be one of the better spaces to be in over the next couple of 6 months to a year, maybe even longer, if if they can keep their cases under control and limit the amount of stimulus that they have, and we'll see EM continue a little bit higher. Now, one concern with regards to currencies is that if the US dollar is to continue lower and stay lower, that could be problematic in the extreme long term for emerging market countries and foreign countries that do export quite a few goods to the US, as those goods will become a lot more expensive for US buyers. But as we all know, the US has been a consumer country, and we certainly haven't slowed down as of late, it seems, and I don't think we're going to continue, or we're not going to slow down anytime soon. However, it may be at some point in time that U.S. goods become similar or competitively priced with some of these emerging market goods, and then therefore U.S. consumers may substitute those goods, and that could hurt emerging markets in the extreme long term. But that's going to take some time to come through, considering the fact that emerging markets have still quite a few manufacturing plants over there, and the U.S. is kind of way behind as far as manufacturing goes, so it would take quite a while to ramp up. Looking at developed international, this is the MSCI EFA index. Have a really nice consolidation here, so this is one that we can potentially target here, depending on which way it decides to go. Obviously, the affinity for stocks has been to move higher, but you certainly see in the international space here this really tight consolidation. Let's see if we can draw a little box around that. Really tight consolidation between 60 and 64. Now, if we see a move lower, I think we're going to really have to break this 60 level significantly in order to get that to break down rather quickly. Let me see if I can get rid of this box now. I'm not very familiar with this system. Sorry about that, guys. Also, as while we're talking about this, let's input some symbols that you guys may have that you want to take a look at further along in the conversation, while I try to clear this drawing. There we go, found it. But anyway, this is a really great chart to look at because you have a really good consolidation level. Now, it may take a long time for this consolidation to render itself and break out or break down, but the longer it goes, it's like that rubber band. The longer you stretch it out, the harder it's going to snap. So, look for this EFA to break out above this 64, 66 level, and it could ramp pretty significantly higher. All right, now that we've gotten through some of the index levels, let's kind of take a look at what's on tap for today. Certainly, big unemployment report. We saw 1.76 million added, and 10.2% on the headline interest, or the headline rate. Expectations were for an increase somewhere between 1.36 million to 1.6 million, and a rate of 10.5 to 10.7%. So very good numbers here. One word of caution is that there is a seasonal adjustment that took place in July. And this happens every year, and it's like clockwork. Many of you know this. Teachers generally get laid off in June and July as school year comes to an end, and then they get rehired sometime in August and September. Now, why is that important? It's important because in the unemployment numbers, in the Bureau of Labor Statistics, their model actually adjusts for this. So in July, generally, you normally get around 850,000 to 1 million teachers that are laid off. Now, that was, unfortunately, teachers were laid off earlier in the year this year, sometime April, May. So in this report, there's a boost of 850,000 to 1 million new payrolls, but it's kind of hypothetical. It's just an adjustment because of this this seasonal adjustment that that the BLS imposes. Now, in August and September, what they normally do is they subtract somewhere around 1 million to 1.5 million of employment, because then teachers are then rehired. So something to kind of consider, take with a grain of salt, in the fact that, you know, we had such a large jobs increase. I think we're still missing somewhere around 10 to 12 million jobs out there, which is why these stimulus measures are so important. Didn't really see any major revisions to the latest report, as the previous was a build of somewhere around 4.8 million hires. And last month, or 2 months ago, June's report was 11.1%. One other thing to consider is that in these unemployment rates, you're not counting a lot of the workers, at least on the headline unemployment rate. You're not counting a lot of the workers who are either discouraged or staying at home because they're making more money on unemployment due to the government stimulus measures, or, you know, they're working part-time. So sometimes it's worth considering to looking at the U6 unemployment rate, which has actually done pretty well. But the U6 includes a lot of those discouraged workers and those that are working part-time purely based on economic reasons. But U6 rate was at 18% for June. July, this month, came in at 16.5%. So we've seen a steady decrease in the in this U6 rate. It started off in April after the pandemic highs of 22.8%. So you're seeing this nice little decline, which is good to see, but we're nowhere near the level that we were in February and March, where March we saw a level of 8.7%. So we got a pretty large disparity there. We did see ADP private payrolls come out this week rather weak. It was 167,000 versus an expectations of 1.5 million. This is a lot of the private payroll numbers, so you don't get any of the government rehires, but kind of a disappointing. But we did see a large revision to their numbers from 2.4 million to 4.3 million in the previous month. So it's basically a wash when it comes down to it. So still seeing good numbers there. And unemployment claims still over 1 million a week, but moved down to 1.18 million versus 1.45 that was expected. Looking at earnings, just going to take like a 10,000 foot view of earnings. In the S&P, at least for this earnings season so far, I think we've seen somewhere between 78 to 85% of the companies report. I have 78% as of midday yesterday, but I think there was quite a few that came out later last evening. It's important to note that 68% of these companies that have already released earnings have beat their guidance or some of the analysts' numbers that they've put out, and 76% have beat on their earnings per share. So good news there, but it's important to note that those numbers have been revised lower quite a bit, considering the environment that we're in. And it's interesting that, you know, the economic environment looks rather poor, but the markets have continued much higher. So you're seeing this large disconnect between the economy and markets, and a lot of that has to do with the Fed and fiscal policy. One other note about earnings, growth, at least growth on revenue and earnings and EPS, has been a vastly different story. Revenue growth year over year, we're seeing down about 11.4%. not bad when you consider, many people were stuck at home, not buying anything, not consuming, not doing anything. So 11.4%, it's a relatively decent number. However, EPS growth down 33.2% on a year-over-year basis. That's getting a little bit concerning because either there's some efficiencies that are no longer there, or something's impacting the ability for companies to turn a profit, despite the fact that revenues are down only slightly. Starting to see some, still having some issues getting this updated, but we're going to move forward. Inflation measures have been crazy lately. I don't know if you guys have seen or not, but gold and silver have been absolutely out of control. Let's see if we can take a look at those real quick. Silver, unbelievable run. I mean, this is a daily chart. So if you see, looking back to April, we're at 16. Now we're at 26. That's a pretty large move there. If we look here back at silver in this consolidation range here, is very similar to that chart that we were talking about with international stocks, but you get this extreme consolidation on a daily over, call it 2.5 months or so, and then as that rubber band snaps, it snaps hard and it moves. So great trade if you were able to get in on this. Still looks like the potential for a move higher is there, especially with inflation coming into play. Gold going to look pretty similar. Also had this long consolidation period here, and then that breakout higher. As we look back, obviously it's been on a trend higher for the long term, but inflation may be coming sooner than we thought. We can see this in TIPS. These are Treasury inflation protected securities, similar to bonds, but have that inflation protection built in. Since the pandemic fears kind of subsided, now we're starting to see this inflation trade come in. So for those that don't have any inflation protection, may want to look, if you're building portfolios, this may be the time to look into something like that. Oil, on the other hand, still struggling to move higher. Have a good consolidation range here, so watch for that to break up if we are seeing this inflation trade come on. Obviously, still well down from the highs, and that has a lot to do with manufacturing slowdowns. All right, so let's get into the important thing of the day today, and that's the stimulus talks, and then we'll get to your stocks real quickly. These stimulus talks have drawn on for quite some time now. There's quite a few sticking points, but there is some consensus points, so we'll take a look at those. President Trump did mention that he could sign in an executive order today if Congress did not meet any kind of an agreement. However, the legality of this is questionable, but will anybody challenge him? It's kind of pointless to challenge somebody from the political sense, in the fact that would really hurt your career if you're getting a president that wants to move stimulus forward and you're trying to blockade it. So whether he does it or not, that's a different question. But if he does, I doubt you're going to see any kind of any challenging. Some of the sticking points that Congress is looking at, Democrats are looking for that continued push of $600 per week of federal unemployment assistance. I think the GOP and the Republicans started off somewhere around $200 per week, which was a rather low number. I think they've come up to now about $400. So still a little gap there between $600 and $400 as far as what they're going to or try and get to those people, or for stimulus measures. But hopefully they'll be able to resolve that. Another major sticking point is the state and local government funding. Democrats were looking for around $1 trillion, whereas Republicans were looking for somewhere around $200 billion. We've heard Trump time and time again saying that, he doesn't think that state and local governments should need any federal help. They should be doing some things on their own. The last sticking point that we're seeing is a new round of the Payroll Protection Program, the PPP. Eligibility appears to be the major issue after the last 2 rounds of PPP, where anybody and everybody could pretty much apply and receive that PPP money. Now they're trying to restrict it based on how much revenue you lost in that period of time. Republicans are looking for companies that have lost more 50% or more of their revenue over that time period, and Democrats want to see that closer to a 20% level. Relative good consensus, though, as far as $1,200 per person, $500 per child, with the similar income threshold limitations that we saw previously, and the eviction ban through the year end, which would be rather helpful for a lot of these renters, but also hurt some of these smaller landlords that don't have quite the capital. USPS funding, they've all agreed upon $10 billion or so. So with that said, we have a few minutes left. Let's take a look at some of these stocks here. I've got quite a few here from a few people, looking at PAAS, Edit, Serve, SPAC, GDXJ, a few others. So if you have any others, feel free to put them in. Let's take a look at these real quick. Pass, Pan American Silver. We talked about silver earlier. It's done really, really great. I think you're going to start seeing some of these miners come in as well. But looking at a nice little breakout here, good trend higher. You had obviously this pandemic issue here, but all green going forward here. So if you've been trying to short it or short any port of silver lately, you've not been doing too good, unfortunately. 30-minute chart does show a little bit of, on a short term here, shows some resistance on the high side, but that's an intraday short trade versus the daily long-term trend has obviously been higher. Good stock if you've been long that one. Editas, nice little breakout as well. This must have been earnings related potentially, I would guess. But good breakout there. I don't know if we go back any further. This looks like an all-time high. So not a whole lot that we can glean from this data. However, we do know that down here on this altimeter, you have really good support, and I would guess that the radar would show that as well, with this line in the sand here in the yellow at $30 down to about 30, or 30.70 down to about 30. So good support there. If you're a long-term holder, you may want to look to pick up some more there. But good looking for Editas. Let's see here. Servicemaster, if I'm not mistaken, I believe this is a company that does similar stuff to like ServPro. They're not ServPro, but they do a lot of cleanings and corporate cleaning and whatnot. So with the pandemic, I think you may see a higher level of sanitation for companies. So I think we've actually really liked this stock quite a bit. Had a nice little breakout higher here, which I believe was on earnings, and then retraced lower. Has some good support here. On the longer term, we're kind of in this gap. So, I mean, the trend should be higher, but again, if there's some macro event that should take place, that could be troublesome. But again, you have good support down lower on this position if you're a long-term holder. SPAC, Andrew's really familiar with this one. I'm not so familiar, but certainly in a downtrend right now. You have this really wide altimeter range, which indicates that there's a high level of volatility for this particular company. So be careful with these high volatility positions. Taking any large position in these stocks, because you can get whipped around pretty quickly. On a shorter term, you have a nice breakout here with the potential to move up to 13.8 to 14.20 or so. Let's see if we can get through a couple more just real quickly. GDXJ, oh, this is the gold miner juniors. Yeah, so this one's come up quite a bit, similar to the GDX, which is the gold miners. So continued move higher here. Not a lot of levels that we can look at other than, buy on any support, it looks like at this point in time. Last one, JPM. JPM looks like not doing too well right now. So we're underneath this level here. And what's interesting about this, if you guys are still on the call, is that you have this altimeter point of control is the same as the unfair low, which means there's an increasing amount of volume here. So this is going to be a real difficult line here. You'll see this even greatly with the with the radar, but down below here there is some further support down below, but below that I think you're going to have some trouble with JP Morgan. But otherwise, good support down even further. So, watch those levels if you're a long-term buyer, as places to try and to pick at it. But otherwise, looks like it's kind of been on a short-term downtrend here. Let's watch for that to resolve over the next week or so. All right, everyone, have a good trading day, and we'll look forward to seeing you guys all next week. Thank you, and have a good rest of the day.